Welcome back to Laying Down the Law, presented by the Orlando Law Group. The answers provided in this show do not constitute as legal advice and do not create an attorney-client relationship. For legal advice, please call the Orlando Law Group's office at 407-512-4394. That's 407-512-4394 online. At theorlandolawgroup.com, our guest is Sonia Narvaez, President and CEO at CPA and Accounting and Tax Services, located right here in Orlando. And, of course, Jennifer Englert with us as always.
Now, what if you have property, like your small business is renting properties? I know there's always a whole lot you could do with that tax-wise, and we could talk about that more generally. If there's something specific to CARES Act, feel free to talk about that too. But if you've got a property or two and you're running that as a business because you rent it, what are some good tips on how to deal with that to maximize your tax benefit?
Okay, so we're saying like if you as an individual owned the real estate property.
Yeah, if you own properties but you use it as a business, like if it's in an LLC or some type of business, or even businesses who own their building in a different LLC, because I know we both know a lot of people do that too.
Well, if you basically have an LLC, this is going to be a pass through, so it's going to come as a deduction to you, according to depending on your income, of course. But there is no additional benefits under the CARES Act. Now, there is one little thing that that you want to think about. If you have a PPP loan and you're paying this building, and you had a loan, you had an agreement, and you've been consistently, you can prove that, you actually can get your rental paid and forgiven through the PPP loan. That would be under the CARES Act. As far as just having regular real estate for renting to your business, it's important to keep a good profit and loss. I would definitely recommend that people have its own bank account. It's easier in case of an audit, in case of whatever that happens to that particular business, especially if it's an LLC, it keeps it as its own entity. And it is very important to calculate that depreciation every year. It is required. It could be a problem if you sell that business, sell that real estate, and you have not calculated depreciation. Now we have to go into a total different situation. So the rules under the CARES Act, I think that being able to get it forgiven would be a good thing. The expenses must be kept in a good record every year, and I think that would be pretty much. Is there anything that comes to mind in your practice that I can answer?
Well, yeah, I mean, I'm glad you brought up depreciation, because especially people who have like rental houses, a lot of people, and just like kind of do their taxes on TurboTax or whatever, we get a lot of clients that don't know that you can depreciate property like that. And you just mentioned about, if you don't depreciate. So yeah, could you tell people a little bit about property and depreciation? Because most people, unless they're super savvy, they don't understand that at all, and they don't even know they can do it.
Okay, absolutely. Well, depreciation is literally mandatory, and it needs to be calculated every year. Depreciation it's a small write-off of that property. You cannot write it off entirely, but you're writing a small piece of that property year after year. It's going to lower the taxes that you pay on that property. Depending if you have a profit or loss on that, is going to make your loss a little bigger, or is going to lower your profit. And it is mandatory. It's something that people need to do. Also, now that you mentioned this, besides the depreciation, a lot of people do not even understand that everything that is on a rental property is deductible. Even the mileage that it takes from you to drive from your place to go do the inspection. Very important. Every single thing that you do to that property, even the transportation, visiting your attorney, the tax return, all of that should be kept in a good record so you can lower the taxes. A lot of these real estate properties should be giving you a write-off on most cases, depending on how you're running it. People do not know that and lose on a lot of deductions. And the depreciation is huge. You take that, depending on the type of, if it's commercial property, you get it over 39 years. And depending on the amount, on the size of the property, a lot of times I recommend cost segregation. We actually have a team of engineers that go and do the cost segregation and gives you this faster depreciation based on the type of building that people have. And it really helps out a lot. The bottom line.
Yeah, I mean, you're right. Most people don't do the depreciation at all, but a lot of them don't understand what they could do either. Can you tell me, what do you mean that you have engineers coming in? Does that have something to do with if the buildings are green buildings, or do you do that for all buildings?
Okay, so the depreciation on a building is 39 years. But what we are trying to emphasize here is let's say the electrical part of the building. If it's segregated, if that cost can be segregated, then we can depreciate not this building. Let's say we have a $400,000 building and we can segregate that the plumbing is $50,000, that the electrical is another $50,000. So now, and let's say there's other segregations that I really don't know the engineers actually do this work, that comes up to another 50,000. So now you've got 75,000 that gets depreciated at a 15. The electrical could be at 10 years, which gives you a much higher deduction for your tax return. We segregate, we take the different phases of that building that are not going to be useful for 39 years. We take a portion of each part of that building. We depreciate it differently at a lower amount of years, which yields a higher expense. And this is done, we normally recommend to do into buildings of 250,000. It gives a really, really nice write-off. And if you are having a professional or somebody that's helping you with tying the income levels that you have, this come in very handy to lower those taxes at the end of the year. Very highly recommended, especially if you're buying real estate.
Okay, and you're eligible for that even if you're not the one who built the building. If you just bought a fairly new building, you could do the same thing?
Yes, you can do the cost segregation. Let's say you go and buy a rental house and you want to start investing on some rental houses. It's best because some of these engineering studies and segregations, they're a little bit, they're going to be a little expensive. So it's got to be made your while. So we normally recommend a property with at least $250,000 and up.
Okay, that's a great tip. You made me think of something, though, talking about that, which we haven't touched on yet, but another thing that we get questions about that I don't think people understand, especially people who have like side gigs and all of that sort of thing. What are good rules regarding whether you should deduct like a part of your house or a part of your car that you might be using for a home-based business? I've heard don't do it at all because it makes you have an audit. Some people do it, I think, too aggressively. What kind of do you advise people, especially like I think the number one example is, okay, you're using a room in your house, you work out of your house. What does that look like? What's your advice for people?
Okay, great question. I'm actually representing a couple clients with that problem with the home office. And well, first of all, having a lot of us, you, me, and then many other people, especially in this pandemic, we're all using our home to work out of. So there's going to be there's two rules that we wanna do. I don't like depreciating your house when you're using it for business, because then you have to recapture depreciation. Sometimes it's not even worth it. And it could be a little bit of a flag. It could be a little bit like it's lesser and lesser. I would assume right now it's getting even less than before. But we do have two things that we can use. There is the safe harbor rule for using your home. It's $1,500, no questions asked. So basically, you're going to get a $1,500 deduction. That is going to be for your electric, whatever it is. You get an automatic $1,500 deduction. So if you could use that, or you can use based on the square footage percentage of your home office compared to the total square footage of your house. If you find that out first, and then you take all your bills and multiply them times that percentage, and I mean all your bills, your electric, your water, your maintenance, HOA, cable, etc. And you basically do that, and you have a rightful deduction as long as you keep displays exclusively for the use of this business, and a lot of us do.
So, I mean, is it a red flag for an audit, or is it worth doing? And if it is worth doing, it's worth like really very carefully doing the calculation and not just guessing, I assume.
I would do the calculation. You can do an estimate. I am actually representing, like I said, a client on an audit right now, and the auditor is actually going to take just 15% of every bill as a write-off. And we are not depreciating the house. That's when that's that borderline of the depreciation, because, and I don't want to get too complicated here, but we do have to recapture that depreciation. If you own this property, now when you go to sell it, you got to recapture rules that need to apply to it, and with the new laws of the exemption of primary home. There's no reason for that. I mean, every case should be evaluated one at a time, but that's normally what I recommend, to just use either the safe harbor rule or to write off the other items based on percentage and leave the depreciation, in this particular case, out, because you're not required to do.
You're listening to Laying Down the Law, presented by the Orlando Law Group. The answers given on this show do not constitute as legal advice and do not create an attorney-client relationship. For legal advice, you can call the Orlando Law Group's office at 407-512-4394. That's 407-512-4394. More with our guest, Sonia Narvaez, President and CEO at CPA and Accounting Tax Services, over 20 years right here in Orlando. Coming up after the three big things you need to know right here on WDBO.